We have finally reached the final segment of our morning today. I was going to say the graveyard shift, but I think the old adage that we leave the best to last is probably more appropriate in this case. Steve Romick, thank you so much for joining us.
Thank you for having me. But I beg the question, beg to differ in the graveyard shift. I mean, here we're talking about early morning, so.
Yeah, no, we do appreciate your early rise that side, but you're looking as fresh as ever. And for the listeners out there, Steve is obviously the portfolio manager of the Nedgroup Investments Global Flexible Fund. And in terms of diving straight in, Steve, how do you feel the fund has performed relative to its performance indicator of late?
Well, first, I just want to thank everybody for joining, me and us today for the year-end Nedgroup Global Flex Fund update. Global Flex has beaten its performance, indicator, a mix of the MSCI global bonds, and MSCI World global bonds, and a small amount of cash in recent months, as well as across the 1, 3, and 5-year periods, and since inception. So feeling pretty good about it.
Great, thanks, Steve. And how do you feel, in terms of some of the highlights on the investment side that may have proven to be meaningful behind the fund's performance that we're seeing?
Well, the slide that you can see on the screen displays the fund's top 5 contributors and detractors. And Global Flex's top 5 contributors contributed 7.9% to its return, while its bottom 5 detracted 2.3% from it. In the last 12 months, there was no significant news that drove the winners higher and the losers lower. One company I think might just focus on for just a second, not that it necessarily justifies it being called out, but I do think it will highlight kind of process for us. We own International Flavors and Fragrances, IFF, and the stock is down from our original purchase price. I mean, poor management has plagued International Flavors and Fragrances for many, many years. As a leading producer of food and beverage, scent and home and personal care, as well as health products and ingredients, its products are ubiquitous across so many household staples. I mean, they produce 1/3 of probiotics, and they make the enzyme used in half of the cold water laundry detergents, and they make another enzyme used in 20% of the beer brewed globally. 1/3 of the yogurts used is in IFF culture, just to name a few. Prior management, I mean, in a word, was horrible, which creates the opportunity. Reckless capital allocation, ineptitude at managing its diverse global enterprise. They successfully transformed a high margin, unlevered company into one with low margins and higher level of leverage. I mean, it's like they snatched defeat from the jaws of victory. But now we have a constructive view of the new CEO, who has renewed the company's focus on being best in class operationally with a smaller product suite. They have sold and will continue to sell non-core assets, which will decrease their leverage and will hopefully allow for higher margins. The company's burned the market, and as a result, investors seem to have taken a wait and see attitude, which seems quite reasonable. Our attitude, though, is to really look across the chasm. As we said, we have faith in this new management team, and we believe their current $4 of free cash earnings could increase to $5 to $6 in the next few years. If successful, their PE then should also rise, because their comparable companies, their peer group, trades at higher multiples. So with its current stock price in the low 70s, although it's bounced off its low, reasonable downside, might be just around $60, and its upside could be around $125, taking a 3-year view that excludes free cash flow. Obviously, nothing's guaranteed, but we always try and frame, the upside, potential, the potential reward in the context of downside, and then, gain, conviction and handicapping based upon what a management team is doing. And it sets up well, and we'll see if we can revisit this in the next few years and hopefully have a favorable tale to tell.
Certainly sounds like a potential turnaround story, and a lot of investor anxiety seems to be trapped in that valuation. So we'll follow that one with a keen eye. On that notion of change, interested to hear how the portfolio may have changed in the last 12 months.
Well, we've marginally decreased cash, though it's still higher compared to prior years as we await opportunities. In response to the elevated valuations we see in the market, we continue to trim positions in 2024 and early 25. However, a stock market drawdown that lasts only a few days as it did in early April a year ago, is too short a time frame to shift the portfolio materially. We haven't sat idle, however. During 2025, we added 13 new positions, increased 4, while also exiting 6 positions and trimming another 12, all largely due to valuations on the sales side.
Thanks, Steve. Some of the previous guests, we did a bit of a whirlwind tour around different geographies and sectors and got their sense of the market in those different regions. Maybe yourselves at FPA, is there anything that sticks out for yourselves from a regional or sector perspective?
Well, Global Flex's current asset allocation reflects a low bond exposure at just 2.7%. Yields remain very, very low in corporate bond market. Covenants continue to be, relatively weak, and we just don't think that the risk is justified. And then the not great valuations that I mentioned earlier also explain, the 38% cash exposure, which, as I pointed out, hadn't changed much in the last year. The most prominent risk asset exposure remains the communication services sector at almost 11%. That's a very, very broad category, covers a lot of bases.
Thanks, Steve. So prior to our chat, we had our emerging markets portfolio manager on the call, and we discussed various geographies, and I'm keen to hear your thoughts at FPA, how you are looking at the geographic composition of the fund currently.
About 42% of the fund's exposure is to companies based outside the United States. As we often point out, though, where a company is based is of secondary importance to the quality of a business and the price at which it trades. More relevantly, still, is if we examine the revenue composition of our portfolio companies, we will see that they derive about 54% of the sales from outside of the United States.
Thanks, Steve. And 2025 was certainly a curious year in terms of some of the tensions between momentum and quality. So I'm very keen to hear your thoughts on where are you finding better value in the markets today?
I mean, valuations remain above average in all the world's major regions. Lower than average interest rates offer some justification for this. U.S. companies trade at higher prices relative to their historical average and compared to those based outside the United States as well, which supports our continued interest in investing outside the United States. When people become excited about market prospects, they tend to assume more risk, which can manifest in paying a higher multiple or increasing the risk exposure, sometimes through leverage. And we do see that happening today. So caution is the watchword even as we do look overseas.
Yeah, thanks, Steve. I mean, given everything you've said there, I guess the broad market isn't offering these huge bargains. So I'm curious to know, maybe you can dive a little bit further into where you and the team are finding opportunities.
Well, there's always something to do. While we prefer to own high quality companies and believe they should outperform the market over time, that does not mean that their shares will perform well in all environments. Last year serves as an excellent example. The MSCI Quality Index outperformed the broader MSCI index on average since 1990. But in 2024 and 2025, the Quality Index underperformed, with last year marking the worst in 35 years. Europe, therefore, isn't a bad place to look for opportunity today, given that relative weakness.
Okay, so to steal your quote, there are things to do. So I'm curious to know how do you place that into the context of what today looks like a pricier market?
Well, valuation indices have been driven by large company concentration and AI. I mean, it shouldn't be a surprise to anybody on this call. The largest 10 companies in the S&P 500, for example, make up a record share of the index and trade at high multiples relative to the index and history. The top 10 holdings in the S&P, for example, account for 41% of the index's market cap and 33% of the index's earnings. However, that leaves the rest of the US market trading at a not unreasonable valuation.
Thanks, Steve. If there's one word that I'm going to anchor on after our discussion today, that is that opportunity. And I know your last two slides allude to where you are finding opportunity currently.
So large capitalization stocks, particularly those that are growthier, as I just mentioned, have successfully captured the minds and wallets of investors and now traded unusually high valuations that do not afford the downside protection we prefer should either the growth be less than expected or valuation multiples contract. This chart that you're seeing illustrates how large cap valuations have diverged from those of their smaller peers. We are therefore spending more time looking at smaller companies. So attention to in one area can create, and then inflated valuation that comes with that can then, suck a lot of the oxygen out of the room and create opportunities in another area, which is the case concerning the disenfranchised small and medium-sized companies that Global Flex is poised to capitalize on. So we've been buying mid-cap companies around the globe. This slide shows that as a group, they trade at or below their average multiples over the past 25 plus years.
Thanks, Steve.
And one sector I would point out as being, relatively attractive. There's just another slide that should be up on your screen as well. Is healthcare and specifically life science, particularly earlier in 25, where we spent a lot of time and effort and allocated capital. And from this slide, you can see that we see that some of the lowest valuations in 20 years. So while life science has been a focus in 25, we'd also bought mid-cap companies in the leisure, energy, chemical, buildings material, consumer staples, commodity, telecommunications, and electrical industries. I mean, a lot of breadth. There's just not one area that we've been unusually focused on.
Thanks, Steve. I like your comment there about certain companies and sectors really grabbing the minds and wallets of investors, but it really is about sieving through that noise and understanding what's driving sentiment versus actual fundamentals. And I think that it's what you've made clear in your presentation today. So, as always, from myself and the team here, thanks very much for your time and all the work on the fund.
Thank you very much. Thanks for taking the time.
And to everyone that dialed in this morning, thank you so much for your time and attention. We realize there are a lot of things happening in the investment market and a lot of events happening, so we appreciate your focus and your continued investment and trust with us in these funds. I started the morning session by quoting Mario Andretti that if everything seems under control, you're not going fast enough. So we hope we've given you a sense of control because the markets are moving incredibly fast and the geopolitical movements similarly so. So we do hope that you're feeling a little bit more confident behind the wheel as we embrace 2026. So again, from myself and the team at Nedgroup Investments, thanks for your time and we'll catch up with you soon. Take care.